Hello everybody, Rob Yastrzemski with Remax Elite here, coming to you today with mortgage extraordinaire Andre Hewell with the Mortgage Group.
Correct.
And just wanted to give you guys a quick update on the recent CMHC rules that are going to affect everybody that's pretty much going to put down less than
35% down.
So Andre, let us know. We have the slide up, you may not be able to see it exactly, but Andre will explain to you all the changes from current all the way to what's happening today, right from, 65% loan to value all the way up to 95%. So Andre, how does this affect? What are the changes and when are they starting?
Well, the main issue going on is everything's going to change as of March 17th is when the new rules get put in. So that doesn't mean that you have just a pre-approval by March 17th. What that means is you have to have an accepted contract to buy the home, and it has to be approved by the lender and CMHC by that point. You don't have to have possession by March 17th, we just have to have the offer in place.
Great point.
Now, getting into what changing with the rates is this: if you put down 35% down, the premium is staying the same. They aren't changing that one, but anything less than 35% down is changing. So if you're only putting down 25%, they're changing from 0.75% of a total mortgage amount is what the fee would be, up to 1.7. So almost a 1% hike, just at putting 25% down.
In CMHC premiums.
In CMHC premiums only, not an interest rate. So then at 20% down and 80% loan to value, so you're borrowing 80% of the house. The old rate was 1.25%, and that's really going up a lot to 2.4. So what that means is that most of the Schedule A banks, so for instance, the main 5 banks don't insure mortgages at 20% down. So this isn't going to affect those types of clients. So as a mortgage broker, that's our job to help you navigate that field. Some of the monoline lenders, which I would say as they don't take deposits, but they do help us in the competitive nature of the mortgage market, they insure mortgages at 20% down. So that's where you might see a little change in what they're doing. So that rate goes up to 2.4.
So that goes from 1.25 to 2.4% premium. That's how much more it's going to cost you to get CMHC to approve the mortgage if you're only putting down 20%.
Right. Now, if we're going for 15% down, that premium is going from 1.8 to 2.8. So there's a 1% jump there. 10% down, 2.4 to 3.1. So there's a 0.7% jump on that one. And then at 95% down of our own resources, so when you have your own down payment, 5% down,
yeah,
goes from 3.6 to 4%. So there's a 0.4% jump on that one, which works out to about $5 to $7 a month on an average mortgage. The bottom one I want to also point out is if you don't have a non-traditional down payment, so it's not a gift, it's not own resources, but you're actually borrowing it from a line of credit, okay? That old premium was 3.85, that one's jumping to 4.5%.
So you're saying that someone can have 5% of their own savings, and then they don't have any other savings, but they want to go up to the 90% loan to value, so they want to put down a total 10%, and they want to borrow it from a line of credit, that goes up as well.
Correct. Or if they don't have any of their own down payment whatsoever right now, and they want to borrow the full 5%, we have programs in place that allow us to do that.
Zero down payment, guys.
Okay,
so you can still get mortgages with zero down.
Correct. It's a higher premium to qualify for it, and there's a couple extra rules in place, but it is a possibility. Okay.
Good to know. Andre, so typically, this may all sound very overwhelming. Let's put it into perspective. How much would, on average, and I know we're not calculating this right now, but on average, let's say, how much would somebody's payment change if they were buying the average house, say around $400, $450? And they were putting down, all these different amounts.
Correct. On an average purchase of $450, you're looking at about a $10 a month difference in payments. Okay.
Depending on which one.
Depending on which one, which level you're at. That'll be about on the 5% down.
So it's not going to kill you, but over 25 years, it adds up.
Right. So
So and it does impact your qualifying ability. So if you're that close, right, or does it?
Right, because it's an extra amount that you're borrowing, it will have an effect on how much you can qualify for. So
Right.
it might change it by $10,000. It might not change. That's something we'd have to calculate through. But it could have a little bit of an adjustment on what your actual purchase power would be.
Now, Andre, we've been talking all about the mortgage group. Sorry, not the mortgage group, but CMHC. Now, there are other insurers out there. What's happening with them? Are they changing, and who are they?
Correct. So there's Genworth Insurance as well, and yesterday they came out and said that they were changing it to follow suit with CMHC.
So they're going to have the same
So
kind of.
they'll be the exact same rates, the same everything that they will mimic them, as well as Canada Guarantee is the third mortgage insurer in Canada. The three of them follow suit very closely. So if the announcement hasn't been out already, it will come that they will match the same.
So there is no getting away from it, everybody. We're all going to be impacted by this rule change, and this is what, third time in 3 years?
This is the third time in 3 years that they've changed just the amount of the insurance rates.
So CMHC's coming out with these changes. Why? Can you give us an idea of why are these rates changing so quickly? Like, is there more foreclosures, or what's happening?
There's a couple of reasons. The first one, of course, is the heated markets in Toronto and Vancouver. So they take a look at those markets and they want to really adjust the mortgage market around that, and it ends up painting the country with a broad brush. So that's the first one that kind of comes in. The second part of that equation is the other changes that happened back in December, where they were changing how much the qualification rate is and things like that, which affects your borrowing power. At the same time, CMHC also has to keep more money on hand in case there is defaults in the future. So this is also one of the reasons they're telling us why this is going up, is partly because of needing to increase their cash flow.
Okay, fair enough. So, quick summary then. How is this going to impact people, and what can they do to minimize this impact, and what are the timelines?
So the biggest thing is, of course, is if you're looking at a property at this point, or thinking about looking at a property for this point, call Rob, get him involved in the process, so that way he can get myself or another mortgage professional in the process going to get you at least look at those numbers to see what the impact would be to you. If it's something where we really are on that fence, on that bubble, and we need that extra $10,000 or whatever that number is going to be at, then yes, I'd want you to act as sooner than later, because as of March 17th, then you won't qualify for exactly what you're looking for. If it's something where you don't have that need, where you need to go right up to that top level, then it's something that it might not impact you today, but it's still something I'd recommend you give us a call so we can have that discussion.
Perfect. Well, Andre, thank you very much. As usual, very informative. Really appreciate that. You guys, if you're happy with what you heard here, please share it. It may not impact you yourself, but you may know of some friends or family members, co-workers that are thinking about buying or selling. Please share this video, and hope to hear from you guys soon. Have a wonderful day.
Thank you.